Hello, everyone, and welcome to today's Blockworks webinar, The Future of Tokenization. Today's episode is made possible by Fireblocks. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A function at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand, and all registrants will receive an email once the recording is live. I'd now like to turn the event over to Blockworks Program Director, Graham Perry. Graham, please go ahead.
Thanks, Jane, and good song choice. It was some good Monday energy for us. I'm really looking forward to today's talk, which is the future of tokenization. And I know I'm going to learn a lot, and I'm sure that our viewers will too. Before we dive in, I'd like to give a quick shout out to today's sponsor, Fireblocks. So Fireblocks is a platform for digital asset custody, transfer, and settlement, and has been moving the ecosystem forward by providing safe and reliable infrastructure. If you're a trading, brokerage, asset management, or payments business, I highly recommend you check them out at www.fireblocks.com. And now I think it would be great to do a quick round of introductions with our speakers here. Michael, would you mind going first?
Yeah, sure. So thanks for having us. I'm Michael. I'm the CEO and co-founder of Fireblocks. I think we got a bit of an introduction in terms of what we do, but we are basically in the secure infrastructure, wallet management, and transfer. Working with a lot of folks in the ecosystem and supporting quite a lot of different use cases.
Thanks, Michael. Hany?
Hi, I'm Hany. I'm one of the co-founders and the CEO of Amun and 21 Shares. We make crypto more accessible. We build bridges into the crypto world. We do this through ETFs with 21 Shares, where we're the world's largest issuer of crypto ETFs. And we do this as well in token form under Amun.
Thanks, Hany. And Lucas?
Hi, Lucas. I'm the CEO and co-founder of Centrifuge. Centrifuge tokenizes real-world assets and allows people to lend against them using DeFi. So we're basically unlocking the liquidity that exists in DeFi today for borrowers like SMEs, fintechs, consumer lending sort of space. And we do that by, for example, tapping into Maker or Aave as DeFi lending protocols that sort of provide credit to them.
Thanks, Lucas. So my first question today is just, I guess, an easy one, maybe not easy, but what is the value of tokenization and what do you think is interesting about it? Michael, maybe you'd like to go first?
I can go first. Yeah, sure. So I think that clearly, when we look at blockchain technology in general, a lot of the value is basically actually not through the native assets, but actually what can be built and what can be brought into the ecosystem, especially like how do we represent existing assets on the blockchain, right? Whether it's like copyright, information like NFTs or tokenization of existing financial assets like stable coins or securities. And the fact that now those assets can basically move very quickly between accounts, and on top of that we can build a lot of financial machinery, such as basically all the automated market makers, lending and borrowing markets, and so on. This is basically, in my view, the essence of tokenization. So essentially, almost everything that is being done today on the blockchain, all the new use cases, sort of like underpinned by this kind of unique thing that we can represent one-to-one an asset on the blockchain.
I think very much what you said, Michael. I want to add like one thing here. I believe that like DeFi, tokenization, right? Like it's basically the idea that you have something that that you can represent on chain and you can transfer it around. Like simply transferring, like there's like there are ledgers that are much more efficient. Like you can implement in the traditional world, like that doesn't really add that much. I think tokenization gets interesting and sort of has a benefit compared to to the traditional like idea of custodians and securitization when you start interacting exactly with these other DeFi protocols like you've mentioned. The key point there is actually that I think like you now go from like basically these financial products being implemented in like banking backend software and like legal contracts, right, to like smart contracts that actually like natively can transfer these tokens around. And so you kind of like put together settlement and sort of execution, right, like match orders, execution, and settlement in one step, and that reduces a whole bunch of like unnecessary disconnect and infrastructure that is needed to keep track of both of those.
I think there's two ways of looking at this. One is if you compare it to the systems as they're working today, how is this better? And we can get into more details on that later, but clearly stock exchanges being closed more hours of the day than they're open is something that a lot of people talk about. Can this be better, faster, more efficient in some way? The other way of looking at this, and it's, I think, even more exciting, is what is possible in the tokenized setting that would not be possible in the traditional world. Much like when the internet was invented, there came with it as well innovations in business models, features, what kinds of products, what kind of capabilities we can have in tokens that we may not have in these traditional financial wrappers like ETFs. And I think both of those are valid areas that we can tackle this from.
Thanks, everyone. So maybe digging in a little more to what you said, Hany, you mentioned, stock markets are closed 2 days a week and there's specific hours. So maybe that, or what other challenges in capital markets do you think tokenization can help solve or address?
Sure. So we think a lot about settlements of public market equities, for example, or settlements of traditional assets. Typically, we think about a T+2 settlement. That's not entirely the case across the board. There are bonds that will settle T40 and T60 and crazy things like that. And so at a very bare basic minimum, tokenization should be more efficient, which really is just another word for saying it's going to be cheaper and faster. It would enable us to perhaps tokenize assets that would not be possible otherwise. Tokenize or securitize assets, depending on what kinds of assets these are. But again, what I think is most exciting is actually looking at, well, what new avenues here are impossible to do with how the world operates today. Something that we think a lot about internally at the company, and actually some NFT projects that came out recently showcase this, is the concept of once you are more aware of what your individual customers, the end investors, are doing, you can create more streamlined products. And what I mean by that is in the traditional financial world, you're selling an ETF through a bank or brokerage, and you don't have as much of a connection with the end customer. The same thing applies with a lot of other setups like mutual funds or funds in general, trusts, etc. But what you miss out on is, for example, knowing how long is the average holding period. You are unable to say my customers hold on average our assets for 2.5 years or 180 days or whatever. And if you look at some of the really cool innovations that are coming out of crypto, there are now these hodling guaranteed bonuses and things like that. There are privileges that are associated with long-term holding, which you can incentivize in various means. Moonbirds, which is a top NFT project that just came out, is doing really, really well, has this mechanism built in that a lot of people are going crazy about for nesting or holding on to the asset and then getting rewarded for it. We can now do that with investment products. We can now do that with funds. We can now do that with tokens, because on the token side, in direct opposition to what we see on the traditional financial wrapper side, I know how long someone has been holding. I know what their average holdings are, and you can do all sorts of things to maybe refund fees after a set period of time. And that, again, enables these kinds of mechanisms and features that are impossible to do. And then what could we build on top of it? And that turns out to be a lot of interesting new possibilities.
Yeah, I mean, I agree. I think that we always think about this in terms, or at least like, you know, when you sometimes talk about tokenization with some of the more traditional players, right, banks and so on, the way that they grasp it is just as a more potentially like, you know, a more efficient way where they can make things cheaper or potentially somewhat faster. But agree with Hany that at the end of the day, it actually will unlock so many of those use cases that, you know, occasionally I think we don't really able to think today what can be built on top of that, right? So I think a good comparison is where there is like this famous interview with Steve Jobs that they've been asking him back in the end of the 90s, like, you know, what can you do with the internet? And he would say, you know, you would be able to read your newspaper on the internet. People would say, oh, but yeah, I'm good with my newspaper, I can read it now. Or you'll be able to listen to radio on the internet. People are like, look, I can listen to the radio now, right? But I think, you know, clearly things evolved in a much different way where you couldn't do a lot of the things like, you know, on demand, you know, the creator economy, all the social networks and all those things with the existing technology, right? So the newspapers and the radio was not transferred one-to-one to the internet. A lot of innovation came in. And I think to Hany's point, I think that a lot of those things will be possible once those things will become tokenized, right? Because at the end of the day, the main difference, in my view, some of the main differences between a tokenized world and the world that it is today, at least like, you know, in the capital markets, is that it's true that a lot of the banks and a lot of those financial intermediaries, they invested, you know, tens of decades basically in optimizing those systems to those scale, right? But those systems are actually like, you know, very closed and, you know, they sometimes like, you know, very outdated, and it's very difficult to innovate on them, and it's actually not open to the public, right? If you want to create like a new fintech that will somehow interfere in the way that DTCC is selling securities, there is no way for you to innovate over there, right? It's an extremely closed ecosystem. So once we will get all those assets sort of like, you know, free floating in a tokenized form, I think there will be so much innovation that will come in those DeFi use cases that we are going to see, and also the fact that you can essentially improve one protocol on top of the other. This will be extremely powerful.
I mean, it's like a lot of what you mentioned, right? Like we already see with Centrifuge today, like we sort of like DeFi, and maybe, so for me, like this started with Ethereum in like, for me, it was 2017. Some people got in earlier and sort of like realized, okay, actually like with Ethereum, like there's now a blockchain where anyone can interact with everybody, and you can push your code, you can deploy your token, you can effectively do something that like in the traditional world will cost you millions of dollars, meaning like it takes me today now like 20 minutes to deploy a token, like doing an S1 filing, years of work, lawyers, investment banks, right? Like this whole group of intermediaries and sort of like infrastructure was built around. And of course, some of this infrastructure, where like when we're tokenizing, we need to actually maintain and keep doing. Like there's obviously the regulatory like sanctions checking. There's the obviously securities offerings need to be compliant, but you can like go to DeFi today, create your tokenizer asset, and then get access to like a 24/7 lending market with Aave, right? Where like you now in liquidity providers will provide liquidity by the second, use smart contracts to create some on-chain trading strategies, arbitrage that, say, against Maker that creates stable coins, and do sort of these things that like you have like now actually this ability to do all of this without actually depending on as you mentioned, right, a bank willing to cooperate with you, getting the blessing of the NASDAQ or the New York Stock Exchange to like create some like new way of selling shares, right? Like for example, cow swap basically is we had AMMs in DeFi that provide liquidity like Uniswap, Sushi, and they have flaws. They have their benefits. Anyone can create any trading pair, and you can start to trade any asset, and that's extremely powerful, right? But like, there's front-running issues. There's issues of people not necessarily getting the best price. CowSwap was a project that came along and said, actually, what we want to do basically like batch auctions, because we think that's a better way to give the general public or like retail users a good price and guarantee that like market makers are not necessarily going to take the majority of the profit here on the trade. And like that, they started deploying it, people started using it, and that was all possible, right? Without like any kind of like acquiring a monopoly, trying to get dominant market makers start using it, right? Like it's really just deploying this stuff. And I think that's like the key point of DeFi. And I think they say this insane innovation is coming from exactly that. It's like there's this openness that just creates opportunity.
And I think when you look at the transformation of the internet, this sort of makes sense. Like we still have the best comparison to what's going on in the crypto world is the evolution of the internet. And as innovative as he may be today, Elon Musk's first company was just putting the yellow pages online, to Michael's point, right? That was it. What can I do on the internet? Well, the yellow pages are like the phone directory for local businesses, right? And you can see the evolution across music. To Michael's point again, broadcast.com was just the radio online, and then something, and now we have Spotify and TikTok and other things. And so it makes sense that even with our own firm, the very first tokens we're bringing out are more tokenized versions of some of the things that we see in the ETF world. But then something, and then you'll get innovative new business models, innovative new products that were not possible before. And hopefully, making some of the things that Lucas was talking about simpler and simpler so that they can be more accessible to more people around the world.
Great. Well, that's really interesting. And as you've all alluded to, there's things that are possible with tokenization that aren't possible in the physical world. And obviously there's a lot of potential innovation that's sometimes difficult to conceptualize that far down the line, with the similarity to the internet in the 90s, as you mentioned. But maybe you could talk about like what businesses or organizations should be mindful of when it comes to tokenization. So are there like key decisions that they should make, or where have you seen people go wrong? Where do people go right?
Yeah, I mean, I can start with that. So I think that right now the organizations that we're seeing looking into tokenization, I would just generally divide them into three categories. You have the traditional institutions, right? I think for them, the opportunity and also, I guess, to a certain degree, the threat, right, is to basically take the existing assets that they have, deploy them on the blockchain. The threat is that, as we discussed, that sometimes actually they have the inverse incentive of not basically creating more transparency and just like locking the users into their existing ecosystem that they worked fairly hard to optimize over the last couple of decades. The second category is really fintechs, that I think they actually sort of in the pole position because they have the licenses, they move fast, and basically they if they're doing things correctly, they can basically take a market share, take more market share even from the incumbents. And then the third category is really all the people that are actually not participating right now in the market at all. And those are, in my view, are all the Web 2.5 companies, right? That are, that it's like a fairly large group from, Spotify to Google, YouTube to Shopify to Salesforce, to all those companies that they have huge amount of digital already existing sort of like digital content, right, that by tokenizing that content, they can create new business models. Gaming is another example. And I think that what we're seeing is that all those people are actually looking into what they can do and how they can create new ecosystems. So this is like, quite exciting. In terms of just looking at the first groups, when basically the financial groups, right, whether those are the banks or the fintechs, in terms of some of the initial approaches that were done over there, there is still somewhat of a lot of emphasis around permissioned blockchains, right, or trying to do things in permissioned or federated manner. While to a certain degree it achieves, some of the efficiencies that people are talking about, so far we haven't seen any of those really pick up and basically creating, I would say, a material dent on the ecosystem. And in my view, the reason is that you can only really unleash the power here if you're doing it in a somewhat permissionless manner. Again, we'll talk about later, all the issues around KYC and regulatory aspects need to be preserved. But the problem with a lot of the efforts that were done in that domain are related to in a permissioned or federated domain, is that it eventually created some kind of both a political situation between multiple organizations that didn't allow them to innovate or to launch it successfully, or they didn't really manage to tap into the innovation that happens on the public blockchain, and therefore we've seen like really limited adoption of that. That's my view.
I think luckily, like plenty of consortium approaches were tried in like 2017, 18, and didn't go that far. And meanwhile, like DeFi had like this explosion of use that kind of showed, okay, like if you're not, yeah, exactly as you're saying, right? If you're not doing something that is accessible then to others, then you're really just creating some internal settlement layer that doesn't help that much. I fully agree with you. I think one other aspect that I would say is interesting for tokenization today that you need to kind of watch out for is like there are definitely needs, for example, for Apple stock or Google stock to become part of DeFi, right? Because some people might want to say like sell Apple short and buy ETH or the opposite, right? But that is like, I think, a very small part of sort of the opportunity for tokenization. I think where tokenization will be much more valuable first is actually for assets that sort of like have this illiquidity in the traditional world and are able to unlock this liquidity premium in DeFi that actually makes DeFi much more attractive to them than like pursuing a listing on like on an exchange, right? So like and specifically here, right? Like if we're like, well, we basically have securitized treasury, tokenized treasury bills, which are stable coins. But like beyond that, like the idea of tokenizing some very low risk, like AAA corporate bond is probably not as interesting as, say, real estate, like smaller real estate, like commercial real estate yielding 5%, because actually like there's someone that is like interested in paying a 5% yield, right? And on the flip side, like a small $200-500 million securitization in the traditional world hardly gets any liquidity, whereas like through the benefits of like through this technological improvements that we have in DeFi, right? Like we can actually make something like that liquid. So like these assets actually, they're willing to go through this pain of being an early pioneer in DeFi and tokenization, because they're actually unlocking value for themselves. And I think that's really where I see the most potential in sort of onboarding and bringing these like real world assets into crypto is in those asset classes. And we're seeing that already with like fintechs who are the finance pioneers today, right? Who have the most tech know-how to start adopting it and figuring out what that means for them. And I'm sure a lot of them will start to look at on-chain liquidity as a way to finance their business, to lend to their users, or to give yield to their users on the opposite side, on the flip side, right? Yeah.
I think we messed up quite a bit with some of the earlier tokenization attempts. Real estate being a very good example of it, where to this day, we still haven't seen a lot of great applications of it, despite there being a lot of demand. Because at the end of the day, we ultimately sold a product that took this highly illiquid asset, real estate, and made it more illiquid based on how security tokens end up trading. Something like yield, where Lucas brought it up, especially in places like Europe, where we spend a lot of our time and get negative interest rates, seem like a more reliable part of tokenization that one could sell. And so I think one of the things that we're missing is that we are past the stage where we just need to create basic applications in the traditional world, but in a crypto way. At this point, people don't need a deposit account. People don't need basic payments. A lot of these things have been figured out, but instead we should focus our time more on what can we do here that is impossible to do, or that is so much better, a 10x improvement in speed or efficiency or cost or something that is not possible in the traditional world. And that is where we will win ultimately.
Thanks, Hany. I just want to remind the audience that we will be moving to the Q&A portion of the webinar in roughly 15 minutes. So if you do have any questions, please submit them in the Q&A box. Michael, I do want to go back to a point that you made about permission versus permissionless markets and the, I guess, regulatory implications for that. I was wondering if you can go into that a bit more.
Yeah, sure. So it's clear that some of the, I mean, when we talk about security, especially like, security tokens, right, that securities, we need to be very mindful of the regulation, right, because that basically falls under the security laws in the specific jurisdictions, whether it's the SEC in the United States or other regulators, and for good reason, right? I mean, at the end of the day, there are many reasons why that regulation exists, and there are many awful stories of fraud and huge losses that basically retail and other investors lost over the last hundreds of years, right? It's not a new thing. So a lot of lessons have been learned over there, and we need to start looking how those lessons are essentially being applied to blockchains, right? We've seen a lot of similar issues, right, in the ICO boom or burst, right, which I think we want to mitigate here, right? So the two things that I'm thinking a lot about are, one, all the anti-money laundering, right, issues that clearly needs to be applied here, all the measures to make sure that we are not sort of creating a new mechanism to finance terrorism or do human trafficking, or all the awful things that I'm sure that there is a wide consensus that they are bad. And the second thing is really consumer protection, right? Because we want to make sure, and this is actually happening, we're seeing happening already in the NFT space, right? That people are being defrauded, and we need to make sure that we have those mechanisms in place, right? So there are basically two things here. One is to really develop technology that I think right now we're seeing what I believe is the first stages of those technologies coming to the market. A really very basic attack is what we've done with Aave Arc, right? But we're now seeing even better solutions with on-chain KYC and so on. And the second issue, which also is currently there are solutions that are being developed and addresses really to how do we detect fraud, how do we identify that basically someone sort of like, you know, counterfeit an asset that created different assets and now is trying to defraud investors. I think all those things need to be addressed from a technical standpoint, and then we need to work with the regulators and educate them quite a lot, to be honest, okay, to create the frameworks, right, which are not only change the old laws to be compatible with this technology, but I truly believe that the essence here is that we can work with the regulators to create an actually, like, you know, safer and more robust environment, right, using this new technology.
Thanks, Michael. Lucas, do you have anything you'd like to add on that?
Yeah, I mean, I can. So maybe like talking about our own journey, actually, like we at Centrifuge, like very early on said this needs to be public. It needs to be on an open blockchain, because that's the only way how actually like we will deliver on this like increased liquidity and like interoperability. But also like had like one of the most conservative, like reasonable approaches to KYC, AML, and sort of just regulatory compliance with Centrifuge. So when we started working on this, the kind of thing you realize is, okay, well, like DeFi and like open blockchains, like there's nothing illegal about them per se, right? It is like there are obviously needs when you talk about like secure, like tokenized assets, securities or not, or other kinds of assets that you do need to sort of add this layer on top. And so what we did actually was 2 years of work together with Maker to come up with a setup that would allow for our tokens to be used as collateral to back DAI. That those 2 years of work paid off last April, when we were the first real world asset to sort of like actually get accepted as collateral. And now there's about 20 million DAI in circulation that are backed by real estate, fintech, like other fintech loans, like buy now, pay later, and other assets. And so like that's, but so to come back to like wow, permission versus public, like it is possible, and we're starting to figure out as an ecosystem and sort of how to do this. I think there's definitely pioneers. I really like what you guys are doing with Aave Arc. I believe in the long run there will be a sort of like KYC'd parts of DeFi that use the same kind of code, same principles, same ecosystem, but just sort of where you can make sure that you are fully compliant and you only interact with people that are not on the sanctions list, right? And that itself actually, it sounds a bit less exciting to a lot of people, but actually, to me is as exciting, because I think ultimately what makes DeFi is not the fact that you can evade sanctions lists; it's the fact that you can have like code decide where value should be transferred, right? That really is what like a token, a smart contract makes a smart contract, and I think that's sort of what we need to focus on and sort of show regulators exactly, show sort of like the industry, right? Like you can throw out your like Fortran based like T+2 settlement and use a smart contract that calculates interest. And like there's one way that your interest and distributions are calculated. Everyone has access to it, like your bank, my bank, and we can sort of like use that, right? And I think that's where sort of like need to go with like these public markets. That's ultimately where I believe the future is.
Thanks, Lucas. And Hany, glad you made it back. We were worried about you.
Good. Thank you for having me back so soon.
Yeah. So Lucas, I do have changing gears a bit. I do have another question for you, and it's kind of the comparison of I guess tokens to NFTs. And I understand that Centrifuge actually uses NFTs for individual loans on as part of your on-chain credit fund. So I was wondering if you could tell us about that.
Yeah. So maybe to talk about tokens, ERC20 tokens, fungible tokens, right? It's like the nature of them is You can fractionalize them. You can have many of them. They're all interchangeable. NFTs, it's basically just a serial number and an owner for that serial number. So for example, I can own a crypto collectible, which is maybe a CryptoPunk that's just like that looks like a pixelated punk, or I can own a in-game asset. But I can also, and this is what we are using it for, what we're saying is actually when we tokenize assets, we actually tokenize, for example, a real estate investment project, and the NFT is actually the ownership of that project, right? So like by actually then transferring that NFT into what we call pools on Centrifuge, you effectively like pledge your asset to this credit fund, and you can borrow against it. You can draw stablecoin from that pool, use it to actually build out your real estate project, and when you then sell, like when you're then ready to sell, you can basically pay back your loan and get the collateral, the NFT here, that is the tokenized real estate back. And so that's actually how we bring these many non-fungible, illiquid real-world assets on chain. We pool them, right? So for example, we have New Silver is one of the pools, which is a fix and flip lender in the US. They have about 25 million in assets in total, which are over 100 different properties, in mostly on the East Coast in the US, right? Which each individual property is an NFT with like some public properties, like the risk score, the advance rate, certain aspects about it, and then other properties that are off-chain and private, like the borrower's personal details, credit score, social security number, and so on. And those we keep off-chain. I think like NFTs are quite a bit younger than fungible tokens, and it will be a while before we like see a lot of financial products being built for NFTs. They're like for like Centrifuge building this on-chain credit fund. I think we were one of the earlier projects actually building financial products for NFTs. There's now also others, for example, NFTX, which actually creates a way to create liquidity for crypto collectibles. So punks, CryptoKitties, Moonbirds, where you can actually now create, like, get sort of like liquidity on these assets but always there to challenge is, right? Like you need to find a buyer for not just an NFT of your category, but an NFT, but your specific NFT, right? Like if I want to buy a bluebird and you have a red one, then I might want to buy your red bird, even though they're the same moonbird. And so so it's a bit harder, but I believe actually in the long run, you will also see, like, we will figure out a lot of these problems of how to build like these financial products on top of NFTs more and more.
Thanks, Lucas. For the final question, I always like to ask some forward-looking information. I know you already said that it's so difficult to forecast, what's going to be possible in the space. So instead of that, maybe I'll ask you guys what you're most excited about in the next 12 months in the space.
So I'm excited about two things. The first one is basically starting to see more of those Web2 companies coming in and tokenizing such digital content, which I think will unlock a lot of new and interesting use cases online. And simultaneously, I think the interaction of that with payment, with basically stablecoin payment rails, that I think that in the next 12 to 18 months will become something that is much more accessible to people.
Actually, I think not just fintech companies, although I think fintech companies are definitely going to drive a lot of innovation to DeFi and to crypto. I think one sort of development over the last maybe year that has encouraged me quite a bit is that I think institutional, like finance people, like say credit funds, hedge funds, private equity, banks, are really starting to understand that like we're building core financial infrastructure and moving away from just the idea that like Bitcoin and ETH are speculative assets and the only way to get some volatility and like potential moonshot returns in the current market to like, okay, actually, how do I build my business on top of it? And that's that. And I think that will, that's bringing like it's changing a bit the way DeFi work. The users of DeFi, of course, like it used to be crypto, like super early adopters that use DeFi to trade their crypto native tokens, to now actually like financial institutions coming in and saying, okay, this is starting to be ready for us to use. And the more there we can do to enable them to use it, the more actually like AUM or whatever TBL in crypto is going to skyrocket, right? Because I mean, real estate today is a $400 trillion asset class that dwarfs everything in crypto today. And that's only one of the real world assets that could be tokenized, could be sort of brought into crypto.
Let me give an even different flavor than the cool things that Michael and Lucas brought up. I think if you extrapolate this out a few years, it makes inherent sense that at some point the traditional and the crypto world will more seamlessly be tied together, and there's a coming convergence between the two systems, because both should exist in some way, and it's very possible that the and best case scenario for DeFi from an impact perspective is by being the invisible infrastructural layer that actually powers everything, even more than some of the consumer applications we're seeing. And so I'm most excited.
Yeah, we can hear you, Hany.
Everything froze. Can you hear me now?
Yeah, we can hear you.
Wonderful. I'm most excited, not to have any intrigue, over the next 6 to 12 months, and you'll see us do some of this as well internally, the coming convergence between the two systems, where you will be touching a crypto product that is actually built on traditional rails, or touching traditional rails that have greater functionality from crypto products. Some of this will be yield and income generating, but a lot of this will also be on the infrastructural side, and it's coming much faster than we may perceive it to be.
All very exciting. It sounds like we all have a lot to look forward to. But with that, I'll move us over to the Q&A portion of the webinar. Some of these questions will be addressed to a certain person. Some of them aren't, so just feel free to jump in and take them. Our first question here from Nadav is asking, what major barriers exist to getting significant assets in free-floating tokenized form to allow for this open ecosystem?
I'll answer the first thing is I think that it's just like quality inventory, which is like the first thing, right? That we need to have to get sufficient liquidity and sufficient interest, and then also the ability for, I think that potentially if we bring a sufficiently quality inventory, the retail will be enough. If you also need the institution, then the KYC regulatory things need to be addressed to like a much higher degree than what they are right now.
Michael, this next question is from Stefano, and he's asking how to avoid arbitrage on the same asset between the on-chain and off-chain assets. How would liquidity be transferred on-chain without creating issues?
It's a good question.
That's a great question.
I think, Hany, maybe you can talk a bit about how you see art between your ETFs and native products.
It doesn't actually exist on the ETF side because it's all physically backed, and you can redeem for the physical at any point. So there's a trading spread, which isn't quite the same here. Yeah, I wouldn't be able to answer this question, but it's a phenomenal question.
I mean, yeah, like thinking about like if you have part of the market traded off chain and part of the market traded on chain, then I think you will have arbitrage. I think that ultimately arbitrage hopefully is a race to the bottom, though, that you will see a lot of that going down. The more you can the more you can remove any information asymmetries between those two markets. Now that's of course like general like finance common sense, but what that means like in crypto, I think it's going to be like any other market that is sort of like compartmentalized. I don't know how much actually here the fact that we're doing something on chain versus off chain is really different. The one place where this is actually a bigger concern is when you start integrating with DeFi protocols, for example, and like you have a DeFi protocol trying to liquidate an asset in a public auction, right? And those first these on-chain liquidation processes, which is like the equivalent of your broker basically doing a margin call when you're over leveraged, because those are smart contract controlled. They're much less interactive generally and rely on like the on-chain market being actually accurately priced and liquid. And so that is like actually for like that is just what we need to strive for, of course, is like pushing liquidity there. But
yeah. Arbitrage isn't necessarily a negative thing either, right? And I think it's signs of an efficient market. So it's possible that the arbitrage problem is more pronounced at the beginning, where maybe it's an earlier, less mature market, and then it goes away with time. But
I mean, yeah, and
there's something, there's something very interesting with how do we hack this until it gets better.
Well, eventually, what we've seen is always you have the prop trading and the market makers step in, and they basically initially take advantage of the arbitrage, and then a lot of them are coming in, and then basically at some point the arbitrage disappears.
Funny how that happens.
Yeah.
Well, thanks everyone. So this next one from Antonio, I think this one's for Hany, but anyone can jump in, is can you clarify efforts with real estate tokenization and how it's been made convoluted?
So when we were looking at real estate tokenization on our end, and this is a unique use case for us, if you want something in an ETF format, it needs to be highly liquid. It needs to be able to trade on a normal stock exchange. At any point, you're able to add 1,000 shares of this and expand the pool, or subtract 1,000 shares from it and take away from that. And when we were looking at fractionalizing anything, let alone something that is as regulated on a different level, country by country, and sometimes state by state or province by province, it was just much more difficult to do in a way that did not scale up really well. Which is why we talk about tokenization of real estate as, you know, here's an incredible portfolio, here's a REIT, if you will, like a real estate investment trust, versus the earlier promises of real estate tokenization, which is really what I'm talking about here, where I remember in 2017 hearing a lot of pitches about, wouldn't you want to be able to go short the Lower East Side condos above 750K in value, but go long Upper West Side co-ops that are, that nuance is very, very difficult to do at scale, which is why today I think we've seen a lot of, these are marquee properties, these are huge things. And then it turns out that whether that property is in Zurich or New York or in Paris actually changes a lot of this. And so it's not as replicatable as we would want it to be. And from our positioning, where we're running these daily products that need to be liquid to 100%, where creates and redeems need to happen on a continuous basis on a daily cycle, it's just very difficult for us to do that in our position. But that's not to say that it can't happen for big projects or that other people are working on it in other formats.
Yeah, I can add to this from our limited experience in that area. So I think that there are we've seen a couple of challenges. One is clear that we haven't seen so far really like a quality inventory projects, right? In scale, trying to tap in. I know that, I mean, the discussions with the developers and the property owners is probably like, you know, ongoing since 2017 by different people in the industry, but I haven't seen anything so far with the except there is always the example of the Aspen Hotel, right? That was tokenized. And there wasn't something that had like, you know, a big splash and people say, oh, wow, this is like, you know, something that is, you know, big, liquid, and interesting. So there's still a bit like, you know, the chicken and the egg there. And that basically comes with, I think, you know, somewhat of a lack of infrastructure for the big dollars to come in, right? Because even in the project that some of the projects that we've been involved as an infrastructure provider, you basically starting to understand that, okay, you can tokenize the asset, but then there are not a lot. For example, if you want actually institutional investors to buy into that asset, you need qualified custodians that will actually support from an infrastructure standpoint to hold those tokens. And surprisingly, although there are a lot of those qualified custodians that hold crypto assets, they still don't have an infrastructure to properly store and interact with tokenized assets because they don't know how to deal with DeFi or smart contract interaction in general. So there is still some kind of like, you know, immaturity that needs to be addressed at certain parts of the ecosystem to basically level it to the point where we can actually create like this full market that unlock that efficiency. But I think we'll be there by the end of this year. That's the good stuff. Thanks,
Michael and Hany. This next question is for Lucas, and there's kind of two questions in one. But the first, if a property is an NFT in a pool, like the Centrifuge use case, what data do I have access to as an investor to measure the value and risk of these assets? And then the part two of the question is, why did you decide to go with NFTs as asset tokens instead of issuing a different token for each project?
Yeah, so the first question, the answer basically is we have what the NFT is. It's an on-chain representation of the ownership, along with like verifiable off-chain data that can be shared with the investor. So for example, like say New Silver is one of our issuers. They have those 100 different properties. They actually can give you access to all of the information that's private if you sign an NDA with them, and just sort of like that's very common in the credit world. Like say you're thinking of buying a certain credit fund, you'd ask them for what is considered their loan tape, and that is actually then traditionally it's like a spreadsheet, or sometimes I don't know, some people might be familiar with Intex, which is like this like archaic software for mortgage-backed securities and that's how this data is shared. With Centrifuge, actually the idea of the NFT is that we don't share the information on chain, we don't store it on chain, but we commit a hash of it, so you can actually know what is being talked about. You know it's not been verified, and every other investor gets the same information. And they can actually have even like third-party auditors review that information and sort of like do a lot more of that actually completely integrated. And so then you can look at all of this information. What is available on chain is the financing fee, so the interest that the borrower pays, the expected default, and sort of how we calculate the value of this loan on chain, as well as the like maturity and sort of payment schedule. So those are the details that are public. Of course, like that doesn't usually give you enough to value the portfolio, but it gives you a bit of an idea of what cash flows look like. Yeah. So then the second question. So the problem with you're trying to tokenize like a real estate project, you can tokenize $100 million real estate project and try to create a market for that, and that will maybe work. But if you like try to tokenize a single, like if you create a fungible token for like a single $1 million family home, right? Like it's going to be hard to like get people to create and trade these tokens. And so that's why actually what we build is this like really an on-chain credit fund where like you can put several different assets in there, right? So like to use the New Silver example again, like the average loan amount I think is about $250,000. So like you have you get scale, right, and liquidity by putting 100 of them in one pool. And so the NFT is individual loan, and then like our on-chain contracts basically create an ERC20 token that is the senior investment token, and then there's also junior investment token if you want to basically buy the equity of this securitization.
Thanks, Lucas. Here's one for maybe everyone, but what resources would you recommend for someone who's looking to learn more about tokenization and the tokenization of real world assets?
I would highly recommend speaking to customers and potential users of whatever service and understanding their needs. Like, I think on the technology side, we're there. We can do whatever we need to do. And there's not a lot of necessary R&D that one would need there. But I think what we're missing is on the regulatory side, which I agree with Michael. I think by the end of this year and next year, we're starting to see a lot of good progress on that. But I would focus on what kind of thing are we doing? What are people looking for? And why are we doing this as the core pieces? Because if this goes well, it should go viral. It should be very scalable. It should be very much desired on the other side. And I think that is one of those things that we need to be a little bit more careful on, in my own humble and personal opinion. Talk to customers. It's good stuff.
Yeah, or talk to us. But yeah, one thing I posted is a newsletter by this guy called Luca Prosperi, who is a contributor to MakerDAO. His newsletter is called Dirt Roads. He talks a bit about not just tokenization, but just in general, like traditional finance intersecting with DeFi, and like what like an on-chain credit market could look like. And I think, yeah, there's some interesting reads in there. So that should be in the chat now.
Okay, I see that in the chat. So for anyone watching or listening, yeah, you can find the link there. Michael, do you have any resources that you recommend for people that are trying to learn more about the space and tokenization?
Yeah, we have some resources as well, some white papers on the topic. But generally speaking, I do agree with Hany that the most important thing is really to talk with the potential clients, or to understand well the market that you entering into. Technology is somewhat solved, or it's not the complicated part at this point in time. I think the regulatory aspect is somewhat entangled in the first category. When you basically evaluate what the clients or the market needs, you also need to understand how the regulators will view it, because otherwise you will get stuck.
Thanks, Michael. And I see we just have a minute left. So I do want to thank everyone for your time today. Thank you for joining us. I learned a lot. I'm sure the audience did as well. So yeah, thank you everyone for your time. And thank you to Fireblocks for sponsoring and making this all possible.
This was fun. Thank you, guys.
Yeah, thank you for the great questions as well, and for hosting.
Thanks, everybody. Take care.
Everyone.